You know, I think it was Archimedes who used to say, give me a lever long enough and I could move the planet Earth. Or at least that's what my dad always used to say. And, you know, financial leverage is a topic that comes up a lot in business and investments and finance. And I'm not sure it's ever been dealt with coherently side by side, looking at some of the parallels and contrasts. It's very basic to a business in of itself, and you can find examples for individuals as well when they buy stocks on margin. You see it in the ratios that are sometimes called the DuPont ratios of accounting, where you see each component as it fits into another. It's in the beta of the capital asset pricing model, and so on. And to quote another personage, Shakespeare, neither a borrower or lender be, or not to be. And here, a business, if it borrows money, it turns out it makes the good times better, the bad times worse. Here we have some scenarios in terms of revenues, and we made it real simple here. The variable costs are one half of those, and the, let's say, fixed costs, the overheads, salaries, whatever, are the same across the board. And you get the income, and let's say they have 100 shares, and the earnings per share, that's what the investors care about, turns out to be respectively, well, $1, $2, or $3, or $4 per share in these 4 different scenarios. But what if they also had borrowed money, but with half as many shares? Then we see it is instead $0, $2, $4, and $6. And we can make that into a graph. And sure enough, you see it rises at a steeper rate, but also becomes worse as times become more difficult, but also becomes better as results have improved. Thus the term leverage. Case of the business as a whole is one thing, but let's look at that of the individual investor. The individual investor's return would be, let's see, the price of the stock sold minus the price of the purchased stock, the bottom amount, if you will, plus any dividends, minus the interest expense on the loan, divided by the amount of cash put in. You know, and generally speaking, that's the purchased amount. The bottom amount is the dollars put in plus the borrowed money. And I've left out here commissions because nowadays they're almost de minimis. Let's see, that would be minus on the proceeds on the sales side, but plus on the purchase bought side, but because that's a subtraction, so it'd actually be twice those two costs. But nowadays you can buy like 50 grand for only 10, 20 bucks. It is kind of de minimis. So let's keep it a little bit simple here. And turns out, little trick here, generally the bottom amount is the dollars put in plus the borrowed amount. So let's see, let's do an example. Stock goes up from 50 to 60. You had $5 in dividends. There's a total of 15 bucks. Didn't borrow any money, so you totally invested 50. Gives you a 30% return. Now, if you had borrowed half of that, put in half, borrowed 25, let's make it 8%, there's minus 2 bucks. Well, that's a decrease, but it's over a smaller base, which is now 25, and gives you a 52% return. Far better than that paltry 30. Oh, but wait, there's more, or in this case, less. What if we had a decrease of 10 points on that stock, bought at 50 but sold at 40? Well, you still get the $5 dividend, so you'd have a net loss of 5 bucks on the 50, so you'd lose 10%. But if you'd used margin, that extra 2 bucks is subtracted over that smaller base. Now you lose 28% instead of 10%. Oh my. And then there are those ratios. They are relative measures, and there's return on assets. It's really a performance measure for managers inside the firm, and there's return on equity, which is a performance measure outside the firm for investors. And I'm using a Greek letter pi here as piece of the pie. It could be cash flow, earnings per share, aggregate amounts. So return on assets is profits over assets. Fair enough. And you know what that is? That's the profit margin times the turnover. Profits over sales times sales over assets. The sales cancel. Now, to get the return on equity from the return on assets, we need to multiply times the assets, so the assets cancel, and then divide by the equity. There's only a little minor hitch here. Assets over equity is not a standard accounting ratio. They have debt to equity, which I'm labeling here as liabilities to minimize confusion, and they also have a debt to asset ratio, but we need assets to equity. Now, the accounting identity says assets is liabilities, or debt if you will, plus equity, and we need assets to equity. Well, let's see. Equity to equity is 1. Liabilities to equity. You add the two, you have liabilities and the equity added together. That makes assets total over equity. Or you just take the debt-equity ratio, liabilities to equity, and just add 1 to it. Or you can figure it using the accounting identity had you started with the debt-asset ratio, liabilities over assets. Let's do an example. Profits are 40. Sales are 2,000. Assets are 400, and debt is 160. And thus, by the way, equity is 240, the remainder. And the debt asset, the liabilities to asset, is 40%. Well, the ROA is 40 divided by 2,000 times 2,000 divided by 400, or 2% times 5 times, giving us a 10% return on assets. Now, debt to equity, 160 to 240, is 2/3. So I'm going to add 1 to that, making 5/3, times the 10% gives us 16.7%, which is pretty darn nice. By the way, an observation here, you can just look at the math and realize the ROE is always equal to or greater than the ROA. With debt at 0, the ROE is the ROA. Now, I like to point out, just to really illustrate the leverage aspects of this, is suppose we had not a gain of 2% on a profit margin, but a loss of 2%. You know, strike, bad product, drought, something went wrong again. You'd have lost 10%. Internally to the managers. But to the investors, you would have lost 16.7%, illustrating again that leverage. It's at this place we can probably, and rightly so, get a little more theoretical, and that is look at the capital asset pricing model, which uses something called beta. It's a relationship between the market and a particular firm or security. The unlevered beta, if you multiply it times 1 plus the debt-equity ratio, will give you the levered beta. I rewrote this so we can see a common theme here. You notice again that's the assets over the equity. By the way, depending on the color of the textbook, or in the case of those authors who like to cover their assets with various versions of the same textbook, may adjust it for one after the corporate tax rate, recognizing that it's really the tax shield of the cash flows associated with that portion attributable to debt. But in any case, when you increase borrowing, the levered beta increases, and you can put that into the capital asset pricing model, which, by the way, you'll see at the bottom, but I'm getting ahead of myself. In another vein is something called the WACC, the weighted average cost of capital, or a little less problematic, just call it the average cost of capital, KA. And it's the proportion, the weight in the cost of debt, plus the proportion of the weight in equity. And, well, let's see, the proportion in debt and the proportion in equity add to 1, so the proportion in equity is 1 minus the proportion in debt. And what's the proportion in debt? That's the liabilities over the assets, the debt-asset ratio, times the interest rate, times 1 minus the tax rate of the corporation, plus the weight in the equity, which is the equity over asset ratio times the cost of equity. Should note here, two ways to figure the cost of equity is either the capital asset pricing model, there it is again, or, if you will, take the market valuation, which is the two components of the Gordon growth model, the discounted cash flow model, which if you just solve it, turns out to be the dividend over the price plus the growth rate. It's at this point where typically a graph is presented of the weighted average cost of capital, and to make it well behaved, the debt should be always less than the equity. Okay, and then I ask my students, well, let's see, as debt rises, it becomes riskier, so it should increase as a rate as the amount of debt increases. Fine. I ask them, well, what happens to the equity? And the way they think about parity, this goes this way, this goes this way. No. Equity doesn't go down. It goes up as well. And you think, well, gee, if both components are rising, how could you get a decrease? It's because you're shifting to a lower base. And sure enough, you get this saucer shape. And the argument is, well, you might operate at the minimum. And of course, to the microeconomist, knowing that you actually want the marginal rates to be equal, so you might actually have it where the slopes are parallel, but that's for the advanced courses. But I like to point out that sometimes that saucer shape is not downward, but may be inverted. And you do find that in industries which are particularly safe. It's that the saucer is more hump-shaped, making them actually better off to go to the extremes. Utilities come to mind, at least as one example. The assiduous viewer will have noted there were two extra topics which are not so much financial leverage, but instead means toward ameliorating the effects of financial leverage. Bond immunization is to avoid interest rate risk from all that borrowing. And options, which is direct means, especially for investors. Look, here's a graph I made of duration. I'll explain why it's called that in a second. It's the change in the proportion of a bond price due to changes in the bond's discount rate. It's a price elasticity, if you will. And the back piece in the rear is for zero coupon bonds, 45-degree angle, if you will, and it's because it turns out it always equals the maturity date. And a alternate definition of duration is the dollar-weighted, present value-weighted average maturity. And the dollar-weighted present value average maturity of any single payment is the payment date. So thus, the duration of a zero coupon bond, if you will, is always the year that it's due. In the case of a perpetuity, I'll spare you the math, but it's not that hard. Turns out it's 1 plus the reciprocal yield. Turns out the hybrid instruments, compound instruments, are somewhat less, and they even have an instrument called a reversed floater where you can actually create an instrument that has twice the duration for the purposes of immunization, and that's just the going set interest rate minus the difference, which means when it goes up, it goes down, and vice versa, but that's an advanced topic. But before I take you into deeper water, let's bring you back to the shallow end, and that is, think of immunization as a fulcrum, a teeter-totter, where you want the dollar amounts to be offset on both sides, realizing that you want to immunize the equity. So the dollar-weighted assets and the dollar-weighted liability durations should be equal. And, well, if you think about it, that always means the duration for the liabilities will be greater than that for the assets because there's fewer liabilities. And in this example, I have 100 in assets with an average of 12 years, might be a zero coupon of 12 years, or maybe a perpetuity yielding 9.09%. Well, let's see, reciprocal of that is 11 plus 1, that's 12. What would we solve for if we had equity of 40 and debt of 60? Well, you'd want 20 years. And by the way, that illustrates to the financial engineer, you don't want cheap money, you don't want safe money, you want proper money. And it's usually at this point where the advanced topic becomes something they call barbell immunization, which I think is kind of a misnomer. But regardless, suppose you didn't have the ability to choose rates because, you know, the market gives you choices. And maybe the two choices are, well, maybe you have, a 19-year zero coupon bond and a perpetuity yielding 5%. Well, let's see, perpetuity, reciprocal 20, add 1, 21. And in this simple example, you want an average of 20. And, well, let's see, the average, get 20, would be the half of the 19, half of the 21s. And again, that illustrates the point that the financial engineer says, I want 20-year money, not 30 because it's safer, not 5 or 1 because it's cheaper. You know, that's called asset matching. You know what, 6-year loans for cars, 30-year loans for homes and railroad locomotives, and 40-year money for commercial property. Finally, we can look at options as a means to either increase or decrease one's leverage, noting that as an investment guru, I only suggest them as a means in lieu of limit orders. But that's another topic. In the case of a call, be reminded it goes up with the stock. A put goes up when the stock goes down, and selling them is the opposite. If they're in the money, they approach a one-to-one relationship, and they approach zero if otherwise, more so as they approach the expiration date as a function of the square root of time. Options have a lot of variables, sometimes called Greeks, although slightly a misnomer, as we'll see. The delta really is the one that kind of is the focus of this subject, where it's the change in the option as the stock changes. Again, 1-to-1 in the money, 0 out of the money in terms of theory. The gamma is the rate of that change. Vega is a misreading of the lowercase Greek letter nu. It's for the advanced math folks. There's a 1 for the theta for time. Should be chronos, but don't get me started. And rho is for interest rates. Meaning, let's say you had a 0.8 for the delta on a particular call, or you had a 0.4 on a particular put. You could do 5 calls for every 4 securities, or 5 puts for every 2 securities, and you would have, let's say, immunized it. Trouble is, these other factors make these numbers be not constant across time, but that's a whole nother subject, and I've already dealt with that in another video with DrCinvests.